We are positioned for what could be one of the strongest rebounds the crypto market has seen in months. Something unusual is unfolding right in front of us. Just last night, Bitcoin quietly climbed back above $66,000 for the first time in weeks. By this morning, it wasn't just holding, it was surging, pushing close to 70,000. Ethereum followed. Altcoins followed. The entire market lit up green. And I know what some of you are thinking. We've seen this before. Every rally fades. That's fair. But this time, the backdrop is not the same. Before we break it all down, if you value real analysis without the noise, subscribe to Reverse Crypto and smash the like button. We focus on what actually moves markets, not headlines, not hype. Now here's where things get interesting. For weeks, Bitcoin had a strange pattern. Almost like clockwork, around 10 in the morning, heavy selling pressure would appear. Sharp red candles. Momentum killed instantly. Traders noticed it. It became predictable. But then something changed. A major Wall Street trading firm, one long rumored to be involved in aggressive market activity, was hit with legal action tied to insider trading allegations. And what happened the very next day? The 10 a.m. selling pressure vanished. Instead of a red candle, we saw a powerful green breakout. Coincidence? Maybe. But the timing is impossible to ignore. This same firm had historical connections to some of the biggest collapses in crypto, including the chaos during the 2022 downturn. There have long been whispers about coordinated liquidity attacks, forced liquidations, and ecosystem destabilization strategies. While none of that is proven in court regarding crypto specifically, the market reaction after the lawsuit tells its own story. When aggressive short pressure disappears, prices breathe again. But this move is not just about one firm stepping back. There is a second force building in the background: regulation. U.S. lawmakers are actively pushing forward a comprehensive crypto market structure framework known as the Clarity Act. Key Senate figures are meeting to accelerate the bill. And this is bigger than politics. Being anti-crypto is becoming less popular by the month. Bitcoin is no longer a fringe experiment. It's a trillion-dollar asset class. Supporting innovation while applying smart regulation shouldn't be partisan. Opposing Bitcoin today is like opposing artificial intelligence or smartphones 15 years ago. It's infrastructure, it's software, it's financial rails being rebuilt. Even voices aligned with the Trump camp are pressing Congress to finalize crypto legislation quickly. The message is clear. If the United States wants to remain financially dominant, it must lead in digital assets rather than resist them. The timeline being discussed suggests advancement within weeks, potentially signed into law shortly after. Markets don't wait for paperwork to finish. They price in expectations, and smart money understands what's happening. Long-term capital allocators see Bitcoin not as a trade, but as a generational asset. Research leaders at major digital asset firms managing billions argue that Bitcoin reaching 7 figures within a decade is not unrealistic. We've seen massive drawdowns before. 70% corrections are part of this asset's history, but every cycle resets higher. Investors often get distracted by short-term volatility. Headlines scream fear. But structurally, Bitcoin has never been stronger. Regulatory clarity is improving. Institutional adoption is accelerating. Demand for hard assets like gold and Bitcoin is rising in a world drowning in debt. Those are long-term tailwinds. And when you zoom out, that's what matters. Let's talk about liquidity, because liquidity drives price. Since the October sell-off, capital has been drained from the crypto ecosystem. Stablecoin balances declined. ETF flows turned negative. That removed fuel from the system. When liquidity dries up, even strong assets struggle. But here's the key. While liquidity weakened, fundamentals improved. Institutional access expanded. More wealth management firms began approving Bitcoin ETF exposure. Major brokerage platforms started opening the doors for clients. Bitcoin ETFs have only existed since early 2024. That's barely a year in the lifespan of a financial product. Bitcoin itself has only existed since 2009. We are still early. When liquidity returns, and it always does in cycles, the setup is powerful. Low liquidity environments often create mispricing. Positive developments accumulate quietly while price stagnates. Then when capital rotates back in, the rebound can be violent. Even prominent corporate Bitcoin advocates are now discussing broader programmable digital asset ecosystems. The concept of programmable credit is gaining traction. Tokenized funds, digital securities, blockchain-based settlement systems operating across exchanges like Nasdaq, London markets, Ethereum, Solana, and major brokerage infrastructures. This isn't about speculation anymore. It's about financial architecture being rebuilt. Psychology also matters. $100,000 per Bitcoin is emerging as the next major mental milestone. Once markets normalize around a new level, what once seemed impossible becomes standard. First 10,000 felt outrageous, then 20, then 60. The same progression will happen again. Some investment strategists project Bitcoin reaching over $1 million within 10 years, implying a 20-fold increase from current levels. Others argue a 10-fold return over 5 to 10 years is conservative given the scale of disruption underway. Remember, money and finance are the largest markets on Earth. If blockchain technology captures even a fraction of that value, the upside is enormous. And here's a statistic most people ignore. Roughly 95% of global investors still have zero Bitcoin exposure. Think about that. The majority of capital hasn't even entered yet. When adoption shifts from 5% to 10% to 20%, supply dynamics change dramatically. Comparing Bitcoin wallets to early internet adoption, we're closer to the mid-1990s stage of growth. After 1996, the internet went exponential. Early infrastructure builds quietly. Then adoption accelerates. So no, it's not too late. If you're buying Bitcoin today, you're not late. You're ahead of most capital. Between regulatory momentum, institutional adoption, liquidity cycles, and structural technological innovation, the long-term thesis remains intact, arguably stronger than ever. Short-term volatility will continue, corrections will happen, but structurally, the foundation keeps strengthening. Exciting times are ahead.